All right, good morning, everybody. So we had some data from Japan in the overnight hours. We have more tonight, including CPI. So it's something to think about, as we near the end of the day today, be kind of thinking about a move between the close tonight and the open tomorrow. First blush that I've been able to pick up on this is if they come in and play kind of save a hoe, then we're likely to see some defense along the bonds and a rally in the equities. Yeah, it's something to think about, right? For today, we have jobs, and Waller. There's also some additional auctions today that's going to come in, and we got Kashari, but that's later tonight after the market. All right, so we can see that Asia kind of stalled out after that big move. Today in the Asian market, they didn't go anywhere. It's a doji. And I mean, it's a classic example of complete indecision, right? No theme, no direction, no mantra. There's just nothing there. 100% doji. For the London session or Europe, they had that nice rally up yesterday, stalled out. Now we're getting like a bear sandwich. It's not, but it's kind of close. We're still inside day, and we're less than 50% of the candle, right? So we've already faded off. One thing worth noting, however, is they did rally back up off of those lows. And when we get into the futures today and look at the ES, we're going to recognize that rally as well, all right? So it's kind of a little bit of a bleed over. With WTI, we're still in the range that we've been in, the same discussion that we've had. Nothing's changed. It's a whole bunch of hurry up and wait. And with Brent oil, same thing, Brent crude, a whole lot of nothing. So at some point, it's going to break this range. Until then, these just remain data burners. There is a discussion of a downside break that would get us into this lower structure around 64, 65. But energy, and especially WTI and Brent, it's such a hard thing to run technical analysis on, because a lot of what moves the market won't be any pattern that you see on the chart, right? It'll be outside data and outside sources, much more so than just, say, your typical equity market. When it comes to trading crude and Brent and oil, you're much more, your attention should be focused more on data points and not on the chart itself. So we have a lot of medium impact events today. And then we have additional auctions at 11, 11:30, but not one at 1 o'clock. So once we get past the 11:30 auction, we're good to go, other than any speakers that may populate in the afternoon, right? So for you 0-day traders, you got a pretty clear afternoon. There is a nat gas report at 10:30, and nat gas is something that everybody's been keeping their eye on after that massive sell-off in 2023. It's worth kind of keeping an eye on it. So volume this morning, cumulative volume is within the normal range. Nothing really to see. It is worth noting that the market didn't see anything to wait on. So even though we have ECB minutes coming out at 7 o'clock, we have all this other like job data and everything else. Got a full book really of econ this morning. The market isn't waiting on any of it. On those days where the market deems that the pre-market economic event is going to be big, we'll see this volume come in really light, 70, 80, and we're looking at 145 this morning. So the market kind of just shrugging it off like whatever. Consistent, persistent move to the downside all week. A little bit of a stall on Monday, but otherwise we've been setting it lower nicely each day this week. And nicely is kind of an odd way to approach it, but that's exactly what we have here. There hasn't been any real fear out there, right? It's just been a very systematic, orderly sell-off. And nothing's changed yet. We do have an inside week breakout. We broke below last week's low. Right now, we just hit our head on that level, 39.47. We tested it earlier, and then we're testing it here again. It's trying to get back inside, so we got a little bit of a Busby. Otherwise, we're going to be looking at an expansion finally. We're outside of this box. So one thing about measuring that big candle that we've done right a couple of times this week is projecting the measurement of that candle. $39.14, $38.75, and 3,800. Yeah, okay. We're setting up here for a TRB on the daily. TRB is a trend line breakover. I tend to play the bullish trend line breakover, but there are, of course, bearish ones too. It's the same thing. Just flip it over. So here on the daily, the big picture would be that we're looking for a breakover of this yellow line and then a run back up, which offers us an opportunity to trigger those, what's they called, a machine gun pops, machine gun stops. It's a reversal thing. So if Rob from the Strat kind of came up with it, if you wanted to learn more about it, basically the concept is if people went short, where did they put their stops? Their stops would be above the high of the day that they got in to go short. So if we did get some kind of TRB breakover today, and we started making that run to the upside, that we would trigger into those stops. Well, if you're short, you buy to close. So your stop is a buy order. The run up would trigger buy orders, which would cause more of a run up, which would trigger more buy orders, which would trigger more of a run up, and that would trigger more buy orders until you finally reach the top of the range. It's not my strategy, right? So if you want to argue with it or learn more about it, you just hit the internet because I'm not the one that came up with it, right? It's just a concept. And we've seen the outcome of this many times, whether it looks like that or not, right? See if we can kind of find one here. The general idea would be that on this kind of event where it goes to kick off, that the breakover bar ends up being a massive bar, right? It ends up, one single day making a really, really big move. And it's because of that, right? That it just keeps triggering and triggering and triggering, and it just keeps going and going and going. And you end up with like a Marbozu candle at the end, or at least a bullish Marbozu where it closes right at the top of the range. Now, I don't know that we're going to get one of those, right? I'm not saying that it's going to be that. But it's one of the things that makes a trend line breakover play so good is when we do get one of those, right? Kind of like that day right there. Same setup, multiple downward days, each one with a low just a little bit lower, not kind of out of line. We got a breakover day, and it just expanded really nice. Now, it wasn't the greatest example. Maybe I could have looked around and found something a little better. But it did finally make it to the highest point, and of course, there was no more stops to trigger, and it's kind of where it stalled out. What we need to focus on right now is, one, getting back inside the box if we're going to keep that bullish bend. When you Google it, it's from the guy that created the strat, and I believe his name is Rob, but I've screwed his name up so many times that I'm sure that someday he's going to send me an email. And the discussion that we were just having there, when you do a search, it's either called machine gun stops, or I always screw it up and call it popcorn stops, but I'm the one that gets that wrong. Thank you, Carr. Rob Smith, machine gun, pivot machine gun. Perfect. It's just I don't use it, so I tend to screw the name of it up. But Carr nailed it perfectly. Rob Smith, pivot machine gun. Even though I don't use it, the analysis or the point of view or the perspective that I learned from learning about it is really valuable. I mean, I keep it tucked in my pocket for just such a thing. When I see the setup showing up on the chart, that I can at least recognize the possibility or the opportunity for such an event to unfold, even though I'm not necessarily going to try to trade it that way. I do that with a lot of analysis techniques, by the way, like missed daily pivots. I never trade a missed daily pivot, but I always recognize them when they show up. We don't have one today. We actually hit that pivot and then dumped. But, yeah, that's another one. So we're inside week breakout with a Busby, and we're looking to close outside of the week below this level. If we're going to try to keep that bullish bend, it's really hard to keep that argument right now. We didn't get above 50% of that level that we were focused on, and now we've actually broken down below last week's level. It is worth noting, with a little bit of Captain Obvious to it, that we're in a new month. So how the previous month closed generally is really important. For this chart, for the ES, it's not really such a big deal. But, if you've got your favorites that you like to play, Apple, Microsoft, Tesla, whatever, do yourself a favor and go out to that monthly chart. I don't think enough people spend time out here on these bigger charts. And, most of the time there's really nothing to see. And that's fair. Most of the time, what you look at today was the same thing you saw yesterday, is the same thing you saw last week. The chart really didn't change. It's a monthly chart. But there's times to take a look at it. And one of those times is when we have a new candle. Look at how the other one closed. Consider all of the candle patterns and techniques and opportunities that are out there. Marbozu, for an example, Haramni above the belt, evening star reversals, gap down with an evening star reversal. There's so many different 1 to 2 bar patterns that offer a lot of insight and opportunity. All you got to do is spot it, right? So if you go out there and you don't see anything, fine, you don't see anything, but at least you looked. That'll be a good project to work on this weekend, right? Because it's not like it has to be done today. It's the first weekend of the month. Take a time to go through a number of sectors, industries, sub-industries, names that you really keep track of, and take a look at those monthly charts. You would be surprised, perhaps, if you haven't done it before, at what you get out of it. This really tells the story of what we've been dealing with, and it is a part of what I've heard 2023 is going to be. Now, we never know for sure, but I've heard it said many times already that this is going to be the sideways year. If you take us all the way back to June into October, the range is very clear. And if you wanted to tighten that up and just, bring it down into the new year. So there's December, January, February, March. Tight range. $10-day, 30-minute volume profile, and we are nearly seeing a classic shape. It would be a classic lowercase b in this particular situation. That's what we're going to be looking for. We just have to lose this volume here without getting up into that volume today. And it should happen, right? We've got Wednesday today, and we're going to be losing Wednesday's volume back here, which will be this. So once that drops off, then we're just going to have a little bit of minor volume from Thursday into Friday. And our world at that point will be basically from, say, 4050 to 3900. It's a very narrow range in the grand scheme of things. It's a 10-day range. Today, the main focus is losing this volume across the top. And if we get that TRB that I was talking about, 4014 is the point of control, which will become a significant magnet. So it's going to be what we're aiming for if we do get that trend line breakover today. That's a good starting point. I don't think we need to stop there. That's just what we're going to be focused on as the main event. There is a lot of trash overhead. So any kind of trend line breakover and push to the upside has got a lot of work to do. It won't be an easy run. We don't start getting into an air pocket until we get above all of that trash, right around the cog line at 4030. So if we can get to 4030 and get on the other side of it, we got an air pocket we could move through relatively quick into 4070, 4080. All right, here mapping out the 5x5. No POCs to look at. Anything from yesterday we already wiped out with that drop at the Globex Open last night. 38.91 VPOC to the downside, which it's not too far away, right? If things did start to sell off today, say they're not able to save a hoe and we start dropping down, if we overshoot 3900, we could very easily hit that 38.91. Not a problem at all. To the upside, 4100 is a VPOC. I think that one's a little too far out of reach. The only way we would get there is if some major global event happened, right? Like say Russia bends the knee and bows out of Ukraine. That would spike us to the upside, right? But I mean, that's like a real unrealistic expectation. Looking at where we're at for the year, the anchored VWAP, we are well underneath it, and that's completely established. We're also reasonably decent below the 10-day. 1.6%, which is fine. You know, we've got like a 1.6 ADR, so we could reach up and tag that thing today, no problem. Notice we really haven't rounded over and started coming back up yet. I had someone the other day ask about this indicator and said they just didn't quite understand what we're doing here. So I get it. This doesn't look like a moving average. It doesn't look like anything else that you've probably seen. All we did with that indicator is we're looking at price and a 10-period moving average. And we're trying to answer the question, how far away from the 10 has price gone? Because if it gets too far away, it's going to come back. Think of 10 as the center of the basketball court or the start of the show. Everything starts in the middle of the range. It's the mean, it's the average, it's home, 0. So from that starting point, we expand one direction or the other, above or below the 10. And when we get, quote, too far away from the 10, we will come back to it. What I was trying to accomplish when I developed that indicator is how far is too far, and have we ran too far too fast? Because if we go too far too fast, we're going to flip over and go back the other direction. Mean reversion, linear regression, dot plot statistics 101. Every market has its distance from 10 that becomes its average. Tesla gets farther away from the 10 than, say, Caterpillar does. So we couldn't just generalize and say, oh yeah, whenever a market gets more than 2% from the 10, look for a reversion. That wouldn't work. And then how fast it got that distance accomplished, all of that. So that's what the indicator is doing. It is just looking at this and asking how far away from the 10 are we? Now, I haven't yet done it, but I'm going to do this same thing with an intraday concept on VWAP because the same rules apply. And I'm really thinking that's going to be an awesome indicator. And it'll be more actionable since it's an intraday point of view, I hope. So what we're looking at here, the reason I ran through all of that is, are we on the swing back up yet? If you think about price moving away from an indicator like the 10-period moving average, and then that mean reversion where it comes back towards the moving average again. Once it really starts making that drive towards the 10, it usually gets there or it gets really close. And instead, we've just been kind of skittling along the edges without really coming back to it again. I think today's the day we come back to it. If I'm wrong, it'll be the day that we finally drive farther away from it, right? And you can see like these big expansion bars where it just finally drove and it kind of triggered a reset and price started moving back the other direction afterwards. So I really think that today's either going to be a breakdown serious enough to kind of reset things, shake everything loose, or we're going to come back and tickle that 10. That discussion so far was on the daily 10. Now we're looking at the weekly 10, 1.6% below the 10-week moving average. We haven't really expanded at all, considering how far away from the 10 we've been before. So if you're thinking, wow, we've already gone down quite a ways, isn't that enough? This says we've barely gone down at all, and that we have a long ways to go before we would even start to think that it's been enough. So from a weakness point of view, if we're thinking the market can go down, it's got a lot more room to go. It's not oversold. It hasn't moved too far too fast, and it is not owing us a rebound or any kind of reversion at this point. There's a phrase that exists when it comes to tracking money flows, and it's not my phrase. I certainly don't want to take credit for it, but the phrase is something like, if you don't get capital rotation, then you will get volatility. It's an interesting concept, and so far I've never been able to prove it wrong. So when we're looking for that capital rotation, if it doesn't come, if everything goes in one direction or goes in the other direction without flowing from, say, risky or risk on sectors to risk off sectors, from value to growth, growth to value, if we don't get that rotation, we're just going to get a lot of volatility until finally something breaks loose, and then we get that rotation. Looking at the risk off sectors yesterday, I really don't like to use the phrase overbought and oversold, or even really overextended, but we don't have much vocabulary if we don't use something like that. This has been a pretty significant breakdown in XLP, XLV, XLU. The white dotted line is a linear regression line, and we've kind of expanded beyond the mean, especially in healthcare. But certainly utilities would be next in line, and then behind that, consumer staples. So something to consider if we're looking for a little bit of capital rotation, a move up in the risk off sector is not out of line. Not really impressive this morning, huh? All right, so it says the VIX is up, but that's not necessarily true. If you were looking at the VIX last night, you noticed that there was no VIX until this morning. It opened, gapped up. So it's like a little bit of a change. It all comes from the idea that the VIX isn't real. It's not something that you can buy. You can't own shares of it. It's a mathematical formula, right? This is basically the S&P volume 30 days out. Short and sweet of it. If you look at VRO, the VIX settlement, it records on Wednesday. So there's a change event in all of that. We're not necessarily gaps up this morning in the VIX by that much. I mean, sure, it is up a little bit, but this gap comes from a change, not necessarily because price went up there. So one thing that you can do to kind of track that is look at a different volatility product, something like the 9-day. Now this one is only an intraday product, period. But that one will work once you get into the open, or you can use the VX, which is what I recommended yesterday, so that you could actually track, continuously in the overnight, especially if you were trying to trade futures last night. So you can see we are up a little bit here in the VIX, but at least this one earned it. It didn't just gap up and show up at a particular location. We're still in contango. There's no backwardation showing, which makes sense because, we're not expecting to get out of line. Oddly enough, there's a little bit of backwardation all the way out on the curve between September, October, and November. There's just a little bit there. It's kind of weird. It'll probably resolve itself as the morning wears on. I don't see that it's a big deal yet, but it's worth noting that it's there. Kind of keep an eye on it, see if that cleans itself up a little bit. Really keep your eye on the bonds today. You could use ZB, ZN, I guess, if you really wanted to, or you can just stick with the ETFs. TLT is fine, and then you can look at the yield, like the TNX, something like that. They have to come in today and really try to defend this low, and they've been trying to defend it all week. I mean, that rally yesterday was a kickoff straight from bonds. But we've broken down again this morning. And while the S&P and the NASDAQ and, the indexes, they are important, they're at a level of importance. It's the bonds right now that is on everybody's focus, right? So this breakdown is much more important than a breakdown in the S&P and in the NASDAQ. The $100 level is an absolutely critical level on all things, even in the bonds. $99.35 is the last hurrah. It's the line in the sand. A little bit of note on that would be technical analysis, right? That if we're looking at pivot points and we're focused on, say, coming off of this low and having higher highs and higher lows, we didn't get our higher high, so that's off the table. And it looks like we're about to set a lower low, and that's going to become a really big deal. It kills this whole idea that we were coming out and going to trend to the upside, because you need 2 higher highs and 2 higher lows to define a trend. We only had 1 of each. We didn't get the second higher high, and we're about to fail and not get a higher low. So it really needs to hold above that 99.35. And if we break below it, I think things could get a little ugly. So this is a level to really keep your eye on today. It will be much more impactful than likely anything else that we have econ wise. The 10-year above 4%, that's going to be significant, to say the very least. You can see we tickled that level yesterday, got back inside of it. A breakout of above that level is very likely going to be a catalyst, which is why the idea of Japan tonight with CPI and all the other economic events that are going on tonight, and how we come into the market tomorrow when we wake up and we're having this morning briefing tomorrow. the market we're going to be looking at tomorrow morning will be a direct result of the economic data that comes out tonight from Japan. Before we get to that point tonight, a move in the 10-year or a move in bonds, whether the upside move here or the downside move there, is going to be the catalyst to really focus on. So it looks like Tesla's got a little bit of news this morning that the market didn't like. Maybe Musk is, throwing some fireballs out there. He certainly has a platform now to do that from. And then there was some analyst recommendation changes. So apparently it has something to do with the Investor Day event highlighting higher spending. Well, they're certainly not liking it. Tesla's big enough to drive the market too, so get it, drive. If this goes, very likely it's going to take the rest of the market, at least for a little bit. It will decouple at some point, but not before it does a lot of damage. So let's take a look, kind of follow that down the rabbit hole. Look at EV makers. Or EV markets. XOS. So a lot of these names that are on the bottom this morning, they're slightly green or they're flat. These are more on like self-driving or batteries or the technology behind the EV systems. They're not necessarily automakers. Automakers are the ones that are in red up here. Tesla, Lucid, NIO, Rivian, GM, Ford, Li Auto, XPEV, right? It kind of goes down the list. Tesla's leading the way, down 8% this morning. I looked at this yesterday and I thought, I'll get into it today. I wanted one more day before I got in. And this is what happens when you hesitate. You miss such a beautiful play. So Tesla closed at 202 yesterday. This morning in the pre-market, it's at 186. Because Thinkorswim doesn't show pre-market on the daily until after the market opens, we can either do it this way, just kind of mark a line, or we can turn the chart into a 12-hour chart. So right now, Tesla is below this lowest point right there. And that was the last one. The next one is down at 180. That would be a gap close right there. So that's the one that we want to focus on. Which would be 181.41. It stings, doesn't it? I looked at that for a short yesterday and I shrugged it off and thought, I'll wait, because it looked like we could get between today and tomorrow, a test of this 192, and I wanted to see that and then short it, man, whatever, whatever. There's always another one. So right now the magnet's going to be 181.41. We're going to focus on that as the gap close. Once we get past that gap close, kind of step out here to the weekly for a minute and see if there's anything else. There is a pivot here that I would keep track of. 177.9. $173.22. And nothing there, huh? Now that may seem like a long ways, but nobody's saying we're going to make all of that in a day. Right now, the focus is just going to be that 181. We got an ADR of 5.2, a market maker move of 5. Put those together, that's 10.4, nearly a 10.5. So a 10% move today is not out of line even a little bit. That front vol is sitting at 125 and the back vol is sitting at about 75. Just to round it for a little bit, it's 50 points difference in there. Hoorah. NVIDIA made the breakdown finally yesterday, and this morning is sitting at 124. It closed at 127. I'm just going to round up 2 pennies. So another $3 to the downside on NVIDIA in the overnight. This still has a long ways to go to close the gap being all the way down here. The thing about equity markets and these earnings gaps is gaps are gravity. You know, we tend to go back to them. There's no argument on that. But earnings gaps kind of get shrugged off more, right? They're not as powerful or significant. And I hate to say that because, you know, it sounds like we should dismiss them. I'm certainly not saying that. They just don't have the same weight. But as you can see, there's certainly a significant gap to deal with. NVIDIA did get below the 10 this morning, so that's done. And there's really nothing to slow it down. If we were to keep track of these other gaps, and I mean, I know technically we moved through these zones, so it's not exactly a gap. but it is. We made this move down, and in this move down, we've left these gaps behind, these unfilled gaps. And then we had that earnings, and we popped all the way up there. Again, never traveling through there. We just teleported up there. One of the things that makes gaps useful is the idea of liquidity, supply and demand, rather than support and resistance. If we moved away from a zone really fast and we left unfilled orders behind, buyers that didn't get filled, sellers that didn't get filled, when we finally get back to that spot, they're going to get their fill. So from that point of view, it's still an unresolved gap. That would be the number that I would focus on. 220 would be my first target at this point. We're at 224, so it's not out of line to believe we can go 2 more points. With the way that Tesla's heading to the downside, interestingly enough, it's not taking the market down with it yet. We'll have to see if it kind of bleeds over into other markets or not. At least SPY, it's not taking SPY down. The Qs took a nice shakeup. This is what I was looking at on my other screen, my other computer. So S&P really not feeling the brunt of it yet. IWM still kind of holding the line. Crazy wild ghost print on the Qs, and Tesla waterfalling. Looks like we got analyst rate changes on a number of those EV names too. All right, the NY Fang doesn't do pre-market, so we're not going to see anything on that, but we can already see in KRE, we're down at 60.58. Yesterday, we weren't really too divergent here between these two. If we can get a high correlation coefficient today, we might finally get that drive we're looking for. Looking at the ES or looking at the S&P, it looks like we're primed for a trendline breakover and a run back up. Looking at everything else that's out there, breaking down seems like the more likely choice. So if we put the two together, we get something kind of like this. What you want to zoom in on would be the October 13th day. So we had multiple days in a row, right? Just kind of follow it over from the top. Big down day. A few more days where we were just consistently working our way down lower and lower. And then a big drop down and rally back up. Now that's one of them. I would actually be looking for a gapped down market. And if we were on the SPX rather than the ES, because the ES really doesn't show gaps the same way. There we go. Same date, the October 13th. So we had the big sweeping move, the drop down, the consistently lower, and then this day. We closed here. We opened really gapped down. not much lower than that, and we start working our way back up. This seems much more likely than a continuation to the downside. Make no mistake about it, we can continue to go down. It doesn't owe us a move up today. It only fits the narrative of what I've got that we do go up today, that they're going to come in and they're going to defend on the bonds, and then we're going to get that rally back out. And then tonight with Japan and the CPI and everything over there, that they come in and play save a hoe and save the market. So it fits the narrative. I don't have anything that says it's going to do it, but it sure seems familiar. So the big drive down and then the continuation to the chop. This morning, we've got a gapped down market, which really is trying to rally back up, and we might end up, not being so gapped down after all. But add that to the machine gun pivot concept, and we could get a big driver day where we make it to the top of this range, that 4018 level in the SPX. That'd be 4,000 in the ES, and with some overshoot, 4025. If we get to 4025, it wouldn't be out of line to see us go to 4031, the COG line. There's a lot of pivots over our heads to deal with. So a drive to the upside would be a very hard thing to do without a catalyst behind it, right? Like, what's going to give us this driving force upwards? If I'm talking about the ES or the NASDAQ and you want to take it over to SPY, look at the same candle, right? These three candles. So I'm on SPY now. What's the number? Getting to the top of that candle, 401.28. With an overshoot, 402.29. SPX, it's those same three candles. Always. This is why I just use the ES all the time. These three candles exist on SPY, SPX, and the ES. Their numbers aren't going to be the same, but those three candles are exactly the same. So if I point to the high of this candle on the SPX, you can go right over to the ES and point to that same candle and follow it across. So UOA manipulation, with what you're talking about, there was a lot of puts on SPY, 390. Is it possible that they push it in one direction or another? Yes, absolutely, there is. The thing is about trying to do that on SPY is there's always massive ones on SPY. The best way to answer that question would be to get into spot gamma, because it's literally all they do all day long is focus on dealer gamma, which is what you're asking about. And is the dealer gamma negative enough at this point to get the market makers involved where they'll deliberately monetize the puts? They have this thing called the Hero, H-I-R-O. They use that Hero tool, and you can literally identify real-time options flow, no less, dealer gamma hedging, and how far off they are on one side or the other. I got to get logged in here just a second. So this green line would be SPY. The light blue line would be the Qs, and then the yellow one is IWM. And we're looking at how many days here? We can just look at yesterday's. So that's just the last few hours of yesterday, right? 1 o'clock, 2 o'clock, 3, and all the way up into 4 o'clock. We can look at this number over here. It kind of offers a little more insight on the current dealer gamma range. They're in the positive, not the negative. You know, we can check out their average volume, get all the stats, all that kind of stuff. Is it enough though? One strike and only in SPY, not enough, right? So the idea that some UOA trading activity on one strike in the SPY would be enough to drive the entire market, no. In their founders report, they'll come out and they'll talk about where the largest amount of dealer gamma is, which strike. In fact, if we go over to Finance Juice, spot gamma usually has, why am I not signed in? Spot gamma usually shows up on here, right? So just kind of scroll through some of the noise. You'll see their founders note that comes out every morning. There it is. $390 SPY. The 1 day implied move for SPY is 1.3%. Volatility trigger on SPY is going to be 396, and the absolute gamma strike 400. Put wall at 390, call wall at 399. The zero gamma level is SPY 405. So see, the cool thing is we don't have to try to figure all this out on our own. There are tools in the platform, right, that can kind of get it done for us. Other numbers on SPY would be 387, 377, 392, 389, 387. So we're not getting that breakdown in financials that we need. We've got tech messing with the February 24 low, but it hasn't made the breakdown yet. So it's testing but hasn't broke. But finance isn't even there yet. So it's got a ways to go. If we lose tech and finance on that February 24 low, kind of ties in with everything else, we're primed today for a significant move. We just need a catalyst. So we got the job numbers this morning, and then, I mean, we got some speakers. None of these speakers today seem like they've got it. All right, well, I take that back. I didn't realize Bank of England, that wasn't showing up on the other one. So we got a Bank of England speaker, 10 a.m. We got Waller at 2. So we do have some afternoon ones, and then additional auctions at lunch today. By 0.5% for Fed policy into September, and some are even betting on a 6% by September. That would really drive the market lower. March 22, we have an FOMC meeting. Between now and then, they're going to go into blackout mode, right? 10 days before. So before they go into blackout mode, I think they're going to ramp up their talks, probably see more of them, and then they're going to hit that quiet period. There's been talk of them coming out with a 50 basis point rate hike for March, which would really cause some shock and awe. Looking at the 10-year this morning, oh boy, we are absolutely above that 4%. So earlier when we were looking at it, I was looking at the TNX. It's the ETF. It doesn't really do a good job of showing us in the pre-market where the 10-year is at. Here we're looking at the micro 10-year yield futures. So it does move in the pre-market, and we are very clearly above 4% this morning. That's going to be a big deal. Here is ZB, that's the 30-year futures. Instead of using TLT, the ETF. It's game on to the downside. So bonds need to be defended. And I mean, this isn't my phrase, right? But it's certainly one that sticks. They have to come in and defend this today. It broke that absolutely critical level. And here on the ZB anyways, even though it wasn't on the TLT, we had a higher high. So we had our high, we got a higher high, we had a higher low. That's off the table. We just gave that up. So now a drive back down to 118, 117, it's going to be a really, really big deal. And 10-year above 4%, that's huge. So it looks like we're going to get a rowdy market today. What you're going to want to be looking for, and I don't think we're going to see it, will be something like the plunge protection team come in and try to negotiate something, right? They'll come out and start talking about maybe not going for 50 basis points or right? So some other thing that they can just come out talking on the news shows to kind of curb the selling or flip things over. And then there's the gamma levels. Dealer gamma, 0 strikes, how far away we would have to go before we flip and start running back in the other direction. The CTAs are going to start jumping in on this and piling into the downside move. Now, if we take it out to the daily chart and we focus on that weekly expected move, this range for the week shows that we're not outside the box yet. That'd be 38.91. So from that point of view, we haven't gone too far. We're not going to trigger that next level of selling. But on the day-to-day basis, the 0 gamma levels and dealer hedging that can come in on a day-to-day basis is going to be what I know. I read the number off a little bit ago. It'll be whatever I read off on that spot gamma level. Also, you can sign up for Tier 1 Alpha. They'll send you an email every morning. And they have dealer gamma levels and 0 levels. All right, SPY 395 as first resistance, and then higher above that. We're way beyond that level. Let's see. Higher volatility below 390 in SPY. They call it a liquidity hole because in this area, they're on watch for an implied volatility jump, which will tie into wider spreads and larger price swings. 390 SPY. A short-term snapback in the spot vol relationship, volatility should spike with market declining. Since we're below the 394, that one's already off the table. There's a put wall at 390. That's what you would want to focus on in SPY. That put wall. It hasn't updated today, so it's not showing the put wall at 390 yet. With 0 gamma at 405. We're a long ways from that. $392.24, 389, 387. Just pause my screen there for a second and you take a screenshot. if you kind of put them in a different order so that they make sense, 392, 389, 387, another 387, and then 377. All right, right now we've got 4.5 to 4.75, and we're asking what's the likelihood of getting a 50 basis point rate hike for the March 22nd meeting. A 50 basis point would move us from 450 to 5. 1 month ago, there was 0 chance of that happening. 1 week ago, there was a 27% chance, and now they've priced it up to a 30% chance. Now, it's worth noting that they had priced in an 82% chance that we were going to get a 25 basis point, and now it's down to a 70% chance that we're going to get a 25 basis point. So they're working it. We want to continue to watch any of the news, any of when they speak, anything that asks or implies if they're going to do a 50 basis point. And I know that in the last couple of days, the terminal, the target rate has been pushed up. We've been hearing like, oh, homeboy that was talking yesterday. Neil Kashari said he was open to a 50 basis point rate hike for March. And I think he suggested the target rate was going to be 5.4 by the time they were done. If it was up to him, right? And it's not like he gets to make that decision. All right, Bosick is aiming for 5.25 on the total rate. So they're bringing in the discussion of the 50 basis points, which is how they'll start, right? They'll kind of nudge it, bring it up into the public space, kind of what they call rolling out the truth. So that's what you're going to want to keep your eye on when these Fed speakers are out talking, right? We got Kashari, we've got Waller. We want to keep our eye on anything that they're talking about on how comfortable they are with a 50 basis point rate hike for March. And don't give up on the other ones, right? March is important, but we've still got to think about where is the pause going to come in? What's their final target rate where they say, we're going to get here and stop raising rates? Maybe not cut, but we'll stop raising them and see how things go at that point. And they've also got to dance around and make sure that they don't say something like, oh, we're just going to run on autopilot with, 25 basis point. They use language like that, the market's going to sell off. The last time they tried that, we're going to run on autopilot talk, the market did not like it and tanked. So they're trying to dance around that. The pivot was supposed to be in June. Now it's getting pushed out to September. I wouldn't be surprised if it gets pushed even farther at this point. But it's going to be it's going to be an interesting day today, to say the very least. Really keep your eye on the bonds. It's going to be way more important than any of your other tools or indicators. And I don't even think that the Dixie is going to be much help at this point. Right, looking at the DXY, sure, it's got a little bit of a lift, but there's been a disconnect here that we've been struggling with anyways. If we get above a serious level, then okay, we could probably start to see something significant. So call it 5.1058 and definitely above 106. We're going to start to see the effects of a higher dollar. So I'd say, you guys are probably well armed at this point for the kind of day that we're likely to get. Continue to focus on the idea that we are, one, in an inside day breakout, and two, we're in an inside week breakout. We're still well within the expected move. And for a drive to the downside, if we're going to see dealer gamma hedging really kick in, I would focus on the weekly expansion, not the daily, the day-to-day. The dollar is moving around, but we've started to decouple from the dollar starting back in like November and December. And so we're not getting this tit for tat, tick for tick move like we were getting. And what we're having to do with the dollar instead is like hit these goalposts or levels. So a dollar above 106, that would impact the market. TLT, below 99.20 or whatever my marker was, that would start to get really significant. TNX above 4, which we are this morning already, that would be significant. You have to, instead of seeing just, oh, we got the green candles or we got the red candles, it's going up, it's going down. What level is it at yet? And we've had to do it, that shift. We've had to start doing it that way since, mid to late November, starting into December, it started to get that way. And it's just getting worse, right? It's that decouple that we've been looking for. So it does impact the market. I'm not saying to ignore it. Just that the move alone won't be enough, right? It's how far, at what level is it at? And that was hard to readjust to, right? I got really familiar with a beautiful inverse relationship. The dollar would go up, the S&P would go down. It's an easy short. Now it's not so simple. It's how far is the dollar gone? At what level is it at now? And is it above X level, critical level? Same thing with VIX. That's nothing. Right? Sure, it's down a little bit, but that's nothing. We can check the VIX 9-day once it opens up and see, where that kind of puts us at. And then otherwise you got to use something like SVXY or something. That needs to really fall off if we're going to get that downside move, or we get a TRB across that trend line. All right, so everybody be careful, watch the clock, keep your eye on what the Fed is saying. And for today, yields and bonds, you're going to be your number one go-to. High correlation coefficient is going to be the key. 99 or 100 names all moving in the same direction with nothing moving in the other direction. What I call a consistent, persistent move in the market, nonstop, single drive, nobody taking the other side of the trade. Those are what you're going to want to focus on. Otherwise, we could just bandy about in the range, hold it, maybe even see a Savaho come in and watch this market rip right back up into yesterday's levels. I'll see y'all tomorrow.